Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. Today, we're going to take a closer look at SpaceX's potential initial public offering, specifically focusing on whether the suggested valuation of $1.75 trillion makes sense, or if it might be too optimistic. This discussion will explore the factors that contribute to such a high valuation, including the company's technology, market potential, and financial outlook, helping us understand if this move is a solid investment opportunity or something to approach with caution. On June 12, 2026, SpaceX didn't just go public. It made headlines by raising $75 billion and reaching a valuation between $1.75 and $1.77 trillion. This instantly put it among the most valuable companies worldwide, surpassing even Saudi Aramco. But despite this impressive headline, the company's actual financials tell a different story. SpaceX is generating just $18.7 billion in revenue while losing nearly $5 billion annually. That gives it an unusually high valuation of about 94 times its sales, which is rare even in tech sectors known for rapid growth. Adding to the complexity, valuation experts like Morningstar estimate its fair value to be around $780 billion, less than half the IPO price. So the big question for investors is whether they're buying into the business as it stands today, or if they're investing in Elon Musk's vision of what the future could be. This discussion will explore whether the $1.75 trillion valuation is justified from a shareholder value perspective, or if it might be an example of the market overshooting reality. This analysis focuses on several key areas to provide a clear understanding of SpaceX's current valuation and future potential. First, we'll look at the difference between the IPO price and what the company's fundamental value suggests. Then, we'll explore SpaceX's business strategy and how its growth story supports or challenges that valuation. We'll also dive into financial performance, considering whether current operations are sustainable over the long term. It's important to identify the main drivers behind SpaceX's success, as well as the risks that could impact investors. Ultimately, this will help determine if SpaceX represents a solid, conviction-based, long-term investment, or if its valuation is driven more by optimistic expectations disconnected from real fundamentals. SpaceX operates through three main business engines, each with different economic profiles. The first, Starlink, focuses on connectivity and acts as the profit engine. In 2025, Starlink generated over $11 billion in revenue, making up about 60 to 70% of SpaceX's total sales. It also delivered about $4.4 billion in operating income and is the only consistently profitable segment. Essentially, Starlink combines elements of telecom and software, which is a key reason behind the company's high valuation. The second engine is launch and space infrastructure. This segment is dominant in the global launch market, holding more than 60% market share. While it benefits from high barriers to entry, it remains capital intensive with margins that fluctuate cyclically. Continued heavy reinvestment is necessary, especially for projects like the Starship development, to maintain leadership and technological edge. Together, these engines illustrate a multifaceted strategy with uneven economics but complementary strengths that shape SpaceX's valuation and growth potential. SpaceX's strategy is built on multiple engines with very different economic profiles. The AI and orbital computing segment, including XAI and the so-called narrative layer, currently operates at a loss exceeding $6 billion and depends heavily on unproven technologies like orbital data centers. This area faces stiff competition from established players such as OpenAI, Anthropic, and Google. Although this segment contributes significantly to the company's valuation, it barely adds to current earnings and may even detract from them in the short term. The overall plan is to use the reliable cash flow from Starlink to fund this long-term bet on AI and space infrastructure dominance. This creates a clear tension. Investors are valuing future potential businesses that are not yet profitable. Looking at the segments individually, Starlink acts as the cash generator with high profitability and moderate risk. The launch business forms the infrastructure backbone with moderate profitability but high capital expenditure. And finally, the AI and XI component represents the future narrative, currently operating at a loss with very high risk. This approach highlights how uneven the economics are across SpaceX's portfolio as it balances near-term cash generation with ambitious, high-risk innovation. For this $1.75 trillion valuation to hold and even grow, a few key things have to go right. First, Starlink needs to keep scaling without its margins collapsing. While subscriber growth is impressive, now over 10 million users globally, the average revenue per user is falling, mainly because they're expanding into lower-income markets. So the risk here is that if growth happens without profit margins improving, the overall value could shrink. Second, Starship's commercialization is crucial. It needs to significantly lower launch costs to enable the massive increase in satellite deployment and build out future infrastructure. However, the timeline is tight, and there's substantial risk that these targets won't be met by around 2028 or later, which many projections rely on. Both factors have to align well for the valuation to make sense going forward. Monetizing the AI vision remains a major challenge because orbital data centers and AI infrastructure represent untested markets, and SpaceX faces fierce, well-funded competition in this space. According to Morningstar, this is the biggest source of uncertainty in the company's valuation. On top of that, capital discipline is crucial. SpaceX has accumulated over $41 billion in losses over time, and ongoing heavy investments might keep profitability out of reach for a long time. Lastly, governance and key man risk present significant concerns. Elon Musk still holds a large portion of voting control, meaning the company's strategy heavily depends on one person's vision, which adds an element of risk that investors need to consider carefully. In 2025, SpaceX reported $18.7 billion in revenue, marking a strong 33% growth compared to the previous year. Despite this impressive top-line growth, the company still posted a significant net loss of around $4.9 billion. The market values SpaceX at $1.75 trillion, which translates to a price-to-sales ratio of roughly 94 times. This high valuation reflects strong investor confidence, but also highlights the premium placed on future growth expectations rather than current profitability. Balancing this rapid expansion with ongoing losses is a key challenge moving forward, especially as investors weigh the company's ambitious multi-engine business strategy against current financial realities. Revenue is growing rapidly, more than 30% annually, driven mainly by Starlink's strong scalability. However, the company continues to report significant losses, largely due to heavy investments in AI and R&D, with no clear timeline for reaching sustained profitability. The valuation is extremely high at 94 times revenue, suggesting the market expects almost perfect execution of future plans, which is far beyond what most profitable tech companies see. Morningstar values the company at around $780 billion, which is 48% below its IPO price, highlighting concerns about the uncertainty of the AI business and heavy reliance on optimistic future scenarios. Essentially, the IPO price assumes that the most positive outcomes are nearly guaranteed, which adds a great deal of risk to the current valuation. SpaceX's IPO marks a huge milestone, but it also challenges how markets value companies like this. On one side, SpaceX is clearly a leader in technology and satellite communications, with Starlink offering a scalable, high-margin global internet service. The company sits at a unique intersection of space exploration, artificial intelligence, and infrastructure development, which makes it a very forward-thinking business. However, the valuation at $1.75 trillion raises important questions. This is a company that is still losing money and heavily depends on technologies that are not yet proven, such as orbital data centers and advanced AI innovations. Achieving this valuation assumes near-perfect execution over the next decade, which is far from guaranteed. Ultimately, investing in SpaceX's IPO is less about traditional financial metrics and more about believing in the long-term vision and potential of where this company could go. SpaceX's valuation at $1.75 trillion reflects not just its current business, but the huge potential of what it could become if everything goes right. On one side, it's seen as a generational platform that could revolutionize and lead multiple trillion-dollar industries, especially with its Starlink network and ambitious AI infrastructure plans. On the other side, many view it as massively overvalued, priced as if perfection is already guaranteed. This gap highlights an important point for investors. The company isn't being valued based on today's cash flow or profits, but on belief in future possibilities. When valuation is built on belief rather than solid financials, the risk increases significantly because there's little margin for error. This makes it essential for investors to carefully weigh the optimism against the very real chance that some of these ambitious goals might not be achieved. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.